Well, good morning. Oh my gosh. I would love to say happy good morning and happy sunshine. That's not happening. So I think we're under flood warnings.
I know.
Did
Well,
you
it
hear
was
that?
crazy. I was driving super slow down 285 to get here, and it was and people were flying by me. I'm like, what are you guys doing?
Yeah.
What are you doing?
Until they do a 360 right in
Yeah,
front of you.
I know.
little
I was
donut.
supposed to get my lashes done yesterday afternoon down by Castle Rock.
Yeah.
Canceled that. I was like, I'm not taking my car out in this. I was
No.
like, at like 2:00, I need to be home and in the garage, and I'll just work from home the rest of the time.
And really, really good that you didn't go to Castle Rock down south. Did you see the size of hail?
Yeah. Well,
They were-
tornado was happening yesterday.
Oh my God. And they were like, there were apple size, and we were having so much fun. We were like, cran apples or pineapples? Like Washington apples? Like what size are, but they were big. They were big. Peter was driving to the airport, and he shot me like 3 different videos of like going through like the tundra. Like it was going through the snow lanes the hail made on the highway.
Oh no.
Oh my gosh. So you know what? But here's the deal. So we've got so many great things, and I've got a slide a little bit later on as a reminder for an event that Megan and I are putting on next week.
Yes.
Remember, next week is not a market trends week, but we do have a special event around the tax assessment. I've been going to a ton of offices. I know you've been having a ton of conversations.
A ton of conversations about this.
Yes. So super important that you are the ambassadors for real estate. You need to make sure that you're sharpening your saw, that you're being available, and you're filling your database. I mean, these are possibly listing appointments, right? I mean, there's some people that this is going to impact deeply.
Yes.
And you want to be there and be that resource. So we'll talk about that towards the end. We'll also talk about one of the new Movement Mortgages just rolled out a new down payment assistance. We put that up on social yesterday, but we're going to talk about how that works. But we're going to start off with a quote. We're going to jump into the metrics that Megan's got. My gosh, we got 2 weeks worth.
We got 2 weeks worth, and I'm going to go over some of the monthly report. Yeah. So I got a lot to go over. I got a lot to go over today.
You need an hour and a half.
I know. You guys are going to stick around late today. No recess. It's raining.
No recess. And then we're going to do it again, right? So next week, we're going to have the conversation around the tax assessment, but then we're going to take off from market trends, and then we're going to have market trends again 2 weeks later. So we're going to have all that again.
Yes.
So here we're going to jump in. So let's just start with the quote. With everything happening, there's a lot being thrown at us, whether it's a seasonality, whether it's a change in market, whether it's whatever you're working through coming out of the fourth quarter last year through the first quarter of this year, and now moving forward. I chose a quote that was super simple. We've all heard it. It's when you're served lemons, make lemonade, right? It's about finding the winners. Of course, we just had the Derby. I was talking to several good friends of mine about this. How do you find the winners in this market? Because there's a winner in every market. There's a buyer category, a seller category, an educational category, like with the tax assessment. There are opportunities to be the expert and be the ambassador for our industry, no matter what the market throws at us. So instead of burying yourself, make lemonade, serve it up, and have some fun with it. That's all I'm saying.
Nice. I like lemonade with vodka in it.
I love lemonade. Have you had summer beer?
Summer beer?
It's you take I've had summer beer, and I've forgotten that I've had summer beers. It gets really bad. But you take a thing of frozen lemonade concentrate, and you put it in there, and you put that much vodka in the pitcher, and then you put 3 Coors Lights in there.
Yes, I have had those. Those are a great summer drink. I when the Avs were in the playoffs last year, I have a TV outside on my deck. I sat outside on my deck and drank those.
Yes.
Yeah.
I had them outside the parking lot for a Mammoth game. That's the last I remember.
Most fun Mammoth game ever.
It's true. All right. So what is going on?
Let's get into the monthly stats. And so I wanted to go over that because I have been asked so many times, how would you describe the market right now?
Yes.
And I would describe the market as fickle. It is completely fickle and is so dependent on the location, the condition, and the price of the home. And so it is so important that you guys are on your numbers and you know where it's hot versus where it's not. And so I wanted to go over just the overall market as a whole in March. And then I also wanted to show you the heat maps broken out by zip code so you can see the areas that are hotter than others. And then I wanted to talk to multiple offers about where we're seeing them and how much over asking price people are going right now, because it is not the same game as it was 1 year ago. And so it's really important that you guys have this information and that it's all up to date. And so this is part of the detached single family market trends report that I talk about. And so I'm just going to move this over here.
Okay.
And so this is part of the detached market report, and you're going to get all of these reports. You always get all of my reports as we go through, and as I send out this information to you guys each week, you get the weekly report, the attached report, the detached report, and then the quarterly appreciation maps. And so you get all of those as you go through each week when I send out the copy of the recording of this. And so if you're on this webinar, you don't need to send me an email to get these reports. I will automatically send them to you probably by about noon today.
You don't want those emails?
No, you don't need to send me those emails. You don't need to send me
of
those.
other emails.
Yes. I've been on email since about 3 o'clock this morning, so I don't need any more emails. But we will get a copy of this out to you guys before I head off to lunch today. I have changed the way that I put the reports together, and so I'm trying to force the download right now. So instead of giving you the details in the body of the email, you need to go to page 2 of the report, and that will give you the report. I was able to put a lot more detail into the report than I was able to by putting it into a 2-paragraph summary of the entire month. And so I put it into the report itself so that you've got that perpetual copy of that embedded right in the report. Now, in this report, we talk about market dynamics overall, and looking at active inventory for detached single family, we had about 2,800 available homes for sale in the month of April. That came up by 3.7% from March to April. And we've seen some major gains in the last 2 weeks in April where we saw more new listings making their way to market. New listings actually fell from March to April by about 6%. Pending transactions were down 10.9%. And that's really important that you guys are aware of that. We could have seen our peak production month in March this year. We could have. The podcasts that I'm listening to are saying that March may have been our peak month for production. And so I have seen showings start to drop off. I've seen pending transactions start to drop off, and I've watched my title orders start to dwindle. And man, I count on May to get me through the winter months. And I am not stoked about the title orders that are coming in right now. And so we could have peaked as early as March. So it's really important that if you have listings that are coming up, especially as we start to get into the summer months and everybody has vacation schedules going on, that you are taking that into account as you're going through and pricing these properties, that we may need to ease up on how high we're pricing these properties because our peak might have happened already.
But we're seeing new listings also down. So inventory is coming down along with the market,
so
right?
New listings making their way to market are off by 33% from the same month 1 year ago. So there are fewer new listings coming to market. We still have interest rate gridlock holding people in their homes for longer. The name of the game this year is you have to add to your database. You have to get more people into your database in order to get the number of transactions out that you need, because people are simply staying in their homes for longer because they've refinanced into these 2% and 3% interest rates. And so the reasons why people are moving this year is because birth, death, divorce, loss of a job. Those are the top 4 reasons why people are moving right now. And they're moving this year because they have to, and not necessarily because they want to.
You know how you add people to your database?
How do you do that?
You come to our class on Wednesday.
Yes. Come to our class on Wednesday on tax assessments. We've already got 1,020 people registered online. We have about 80 in person. And so please sign up and register for that. And I'll send out those registration links to you again today when I send out this reminder email. But we want to make sure that you guys get all of that timely information so that you have reasons to connect and provide value surrounding real estate to your client database. Month supply of inventory was sitting at 0.9 months worth of inventory. So it's still signaling that multiple offers are likely. With that number being below 1, we had more buyers on the market than homes to sell those folks. But again, our month supply of inventory is really spotty depending on which part of town you're working in. And so I'll go over that map for you in a second. Overall inventory tends to rise as we get into May, June, July, August, and September. And usually in September, this is where we see the bulk of our inventory hitting the marketplace. But again, we start to see inventory pick up as we go from March to April. But if we compare this to 2013 through 2019, which is where I tend to benchmark because those are similar years to our real estate cycle, I excluded the pandemic years because they simply don't make sense anymore to try and include those. They were such crazy and insane years that it doesn't
Right.
correspond to what we're dealing with right now. But usually in the month of April, we have about 4,600 available detached single family homes for sale. We're sitting at 2,800. And so this is that interest rate gridlock that we're dealing with right now that is forcing the multiple offers to take place in certain parts of our Metro Denver area. Pending transactions, as you can see, again, we came down from 2,800 last month to 2,500, whereas we typically start to build. And in May, we usually have the most number of units going under contract. And I have seen contracts dwindling off as we get deeper into May, which has been interesting. So many challenges in May was to when to list. And so we had Cinco de Mayo on a Friday.
Yes.
We have Mother's Day this weekend. Everybody's graduating from high school and college in the next 2 weeks. And then we have Memorial Day weekend. And so again, if you have to list over a holiday weekend, I advise you to list on a Monday or a Tuesday so that you can get ahead of the weekend and try and get some of those showings in for buyers that are out there and serious about their hunt before the weekend hits and they become distracted with all of their life circumstances.
Sneak peek, mortgage purchase applications actually went up.
They did.
They did.
Okay.
So the demand is not going away. They're just being more picky because it costs more.
Picky.
So if your home is priced right and staged right, the market will drive it up. So price it accordingly to let the market drive it up.
Yes.
If you've done the due diligence on the front end.
Absolutely.
Yeah.
Looking at closed transactions, those came up month over month. And so we had about 3,000 total closed transactions, whereas we typically have about 3,300. So we were only off by about 10% in our overall closed volume for the month for what we would typically see in an April. Looking at our heat map. So this is where I break it out into the top 105 zip codes that I trend across Metro Denver. And again, in order to be included in this analysis, you have to have at least 10 closed transactions in a given zip code for me to go through and analyze it. Otherwise, I gray it out and we skip over it. And so looking at the top 105 zip codes across Metro Denver, when I combine attached and detached residential in order to create this analysis, we had overall 1.12 months worth of inventory. Now, areas that turn red are more competitive. Areas that turn green or blue are less competitive. And so the most competitive areas are these inner landlocked ring suburbs that run around the inside edge of C470. We're seeing a lot of people leaving the city and they're going into the suburbs right now, the inner landlocked ring suburbs. And so areas like our Old Town Arvada are sitting at 0.3 months worth of inventory. Lakewood and Littleton, about 0.5 months worth of inventory. Highlands Ranch, Lone Tree, Littleton, Centennial, all bouncing between 0.4 to 0.6 months worth of inventory. The 225 corridor is seeing about 0.6 months worth of inventory. Montbello at 0.5. And then our little hot spot up here at the top, which is always a real hot area, is in that North Glen community, North Glen Thornton, on the east side of I-25 between 120th and 144th.
This is super specific.
This is super specific.
Yeah. This is like, you got to be intensely paying attention right now.
Yes.
Because if you're in one of those areas, the conversation is totally different than if you're one of the green areas.
Yeah, if you're in one of the green or the blue areas, like in the green areas, for example, just south of the airport, there's substantial new construction at the similar price point as resale is happening. So people are trending towards new construction rather than buying resale. So we've got 3 months worth of inventory out in that market. Out in Bennett, we came up to 2.45. Down here in Elbert County, we were sitting just below 2 months worth of inventory. Parker and Castle Rock, all bouncing between 1.5 to about 1.87 months worth of inventory. Conifer and Pine and Evergreen were a little bit slower this month, whereas they'd been on fire for the previous months.
Yes.
And so those were sitting at about 1.4 to 1.8 months worth of inventory. And then getting up into Brighton, we had 5 months worth of inventory, and Lodo at 5.32 months worth of inventory. So depending on where you are, and Wash Park is slower than what we've been seeing historically overall, and Cherry Hills Village. Those are both sitting with about 2 months worth of inventory right now. So we're seeing that it's slower in the inner central urban densely populated neighborhoods versus what we're seeing in the suburbs right now.
Right.
And I'm going to skip way ahead in the presentation so that we're sure to cover everything that we need to, but I wanted to talk about the multiple offer analysis and what we've been seeing lately in terms of the multiple offer analysis. And so this is my Dr. Seuss graph.
It really is. It really is.
But looking at what happened, and this is based off of closings from April April. So that means they were under contract in March. But looking at that, we had 40.9% of the homes sell for over asking price. We had 22.4% sell for a full price offer and 36.7% sell for under asking price. So that means that about 63% of all the homes sold for at or over asking price if they went under contract in March and closed in April. When we break that out into the different price bands into $200,000 price segments under $1 million versus 1.5 or $500,000 segments between 1.5 to 2 million, and the $1 million segments beyond that, the hottest area was that $400,000 to $500,000 mark, with 45.8% of them selling for over asking price. And it dwindles as you go up in price. Once I hit $4 to $5 million, looking at over asking price was 25%. There were 4 closed transactions. Over 5 million, there were 3 closed transactions, and one of them went for over asking price. But again, about 63% are selling for at or over asking price right now in our market. Those numbers, I won't be surprised if they cool when I start to put together the May numbers, because I haven't seen as many contracts coming in this year in so far this month. I've been actually kind of disappointed at the numbers that have been coming in through May so far.
But it'll be really interesting. I mean, with demand still up, and new listings down, I just wonder if this holds. And you know better than me, so I'm so not going to challenge you because that my half comes next. But it's curious to me because we are seeing demand. We're still seeing our mortgage purchase applications here in this office are up. Buyers want to get in, they just can't find the right house. They're outside their affordability. And speaking of the whole affordability conversation really quickly, when people are buying homes, it's not affecting them, right? Because the tax rate didn't change, but the home prices did. So it's already baked in. It's people that own homes, but they're still dealing with these higher interest rates and higher prices and limited inventory. I just don't know. It'll be really interesting to watch this next month.
To see.
But
those inner landlocked ring suburbs are really what's driving our prices right now. Multiple offers by zip code. So about 40.1% of both attached and detached residential sold for over asking price throughout Metro Denver. So if it turns red, it's more competitive. And if it turns blue or green, it's less competitive. And so again, you can still see this kind of shoddy inner landlocked ring suburbs where we're seeing the majority of our orange, but areas that were really hot, 80228 and Green Mountain was over 50% being in multiple offers. Getting down into Roxborough Park at 58%. We were up to, this is 57% in Highlands Ranch. Over here in the eastern edge of Denver, western edge of Aurora at 55.9%. Just to the south and the west of the airport, we're seeing about 58.1%. DIA, Green Valley Ranch, 64.9% selling for over asking price. Getting into some of the hilltop communities, we're at 50%. Old Town Arvada was also over 50%. And so areas that were cooler down here in Sterling Ranch, again, we've got a lot of new construction with resale going on at the same price. So we're seeing fewer multiple offers there. Down in Castle Rock was only 21.7%. Elbert County came in with 17.6%. Parker was lower overall with about 35%. And out here into the Southlands at about 23.6%. But just south of the airport was only 15.2%. And down here in Lodo, it was about 18% of them selling for over asking price.
But Green Valley Ranch is super hot, right south of the airport. So affordability.
And so it's changing from one neighborhood to the next. I was at a mastermind session on Tuesday, and we were talking about the difference between Low-High versus Highlands versus Berkeley versus Sunnyside, and marching our way to the west down I-70, how it heats up as you get further away from central Denver. It's interesting to see right now, but you have to know your numbers, and you have to know going in how hot that market is so you know where to price your properties. Speaking of multiple offers and how far over asking price they're going, right now, this is not like what we saw last year where we were going 8 to 10% over asking price, but if you were in a multiple offer situation, we were looking at closer to 2.5 to 4.5% over asking price, depending on your price range. We had that one transaction that was 4 to 5 million that went for $500,000 over asking price. That one transaction over 5 million that went for $205,000 over asking price. But for all price points, it's between 2.5% to about 4.5% over asking price. And of course, I've broken this down by zip code for you so that you can see how far over asking price they were going for as you look at the different communities. But our real hot spot was Golden at 8.3% over asking price if you were in a multiple offer situation, versus out here on the south and the east side of town, you're at 1.5% to 2.5% over asking prices. You are up on the north and the east side of town, but you do pay premium prices to live to the west of I-25, where we're seeing the migration pattern to, is where people want to be closer to the mountains. And that's where we're starting to see the bulk of these offers that are going for higher than asking price. Up there in Lakewood, we had another 6% over asking price. Friendly Hills is Belmar, we're looking at about 4.5% to 5% over asking price. Again, out into Morrison, 3.9% over asking price. But the bulk of them were at about 3.3% over asking price if you're in one of those yellow zones. So I'm going to stop that share. It looks like we had a couple of quick questions come in. I'll answer those. And then I'm going to go through just the first portion of the weekly report. You guys see me talk about that every week. So I think that you kind of grab onto the fact that I've got it broken out into $500,000 price points for you, but I'll talk about the market in general. Are you seeing appraisal gaps?
Are we seeing appraisal gaps as far as are the buyers willing to give that appraisal gap away? I am not seeing, we're seeing more appraisal waivers.
In some cases, in those hot zones, yes.
If you're going to go 50,000 over asking, you probably need an appraisal gap in there.
Yeah. Let's see, if you had a choice to list May 19th between Mother's Day weekend and Memorial Day weekend, or June 2nd, which do you think would be more favorable? I would go with May 19th, because once we start to get into the summer, we have vacations going on. People head to the mountains, they head out of town, and we start to see that slowdown. My concern is with looking at the numbers for March to April to what's coming in actively on my desk on May, is that we're in a cooling trend already. And so I would get that listing to market as soon as you can. Let's go ahead and hop into the weekly report, and we'll get that going for you guys. And so we'll just go over the first set of that, and we'll talk about the overall market. And so let's get this set up in a slideshow mode. So this is for May 3rd through May 9th. Looking at these numbers again, I've got the week of the updates for you for your weekly highlight reel. Instead of embedding it in the email, it's now on page 2 of the report to force the download. Looking at where we are for our strategy sheets, here's 2023, and you can see all of a sudden we're seeing more yellow cells start to creep in here. And so that indicates our cooling trend. And the number one metric that I look at is over here on the far left. I'm looking at the odds of selling overall, and it looks like we peaked out the weekend directly following Easter, where we had the highest and best odds of selling so far in 2023. Average daily active count, we came up to 4,164 total available attached and detached residential units available for sale headed into last weekend. That was up by 1% from where we were 1 week ago. Pending transactions actually went up by 1.5%. So we put about 1,100 units under contract, and we've been holding pretty steady at about 1,100 units going under contract each week. Back on markets, 251. That was a 91.6% spike in back on markets this last week.
We're seeing some of that.
Yeah. So we're seeing more units fall out of contract and come back on the market. Overall, it's about a 15 to a 16% fallout ratio all of a sudden.
Wow.
And so that jumped from 8 or 9%.
They want it done.
Buyers are getting cold feet, and they're pulling out from deals right now. New listing activity went up by 12.2%. We had about 1,300 homes hit the market. Overall, we're still sitting at 0.8 months worth of inventory. And so it's still a tight market, especially if you're in those inner landlocked ring suburbs. Looking at where we are for the odds of selling, they decreased week over week as we had Cinco de Mayo going on this last weekend with 64.2% odds of selling. And again, the odds of selling is where I take into account all of the available listings for sale versus those that go under contract and or close in the same week. And I project it forward for a 4.35 week period of time. So this is your likelihood of selling in the next 30 days if you listed last week.
So we have a lot of drinkers, is what you're saying.
Yeah, it took a little bit out of the market. People were having margaritas this weekend instead of looking at houses.
We were debating that on whether or not it was going to impact. There you go.
So slight impact.
Proud of you guys.
Overall, based on the demand from last week, we're still far from a market imbalance. And man, I think it's going to take us years to sort out this inventory issue. I think that we're going to be low in inventory for a long period of time. And I don't expect there to be a huge flood of new listing activity. There's going to be more new listings as we get into the summer because people have families and they prefer to move in June and July. But I don't expect there to be as many new listings as what we've seen in years past. Looking at that, we would need to have about 30,000 total units available for sale. So we only have 13.7% of a balanced market. Based off of showings from last weekend, they declined by about 1.4%. We had about 15,000 total showings that were set, which means you were getting 3.6 shows per property per week. If I can give you any piece of advice, your best thing to take into a listing presentation or setting your seller's expectation is to know these three numbers to set seller expectation going into the first weekend that they're listed. How many shows per property per weekend for your zip code, shows to contract for your price range in your zip code, and median days on market so you can set those seller expectations. Because I'm finding a lot of people that we have to go back and they say, oh my gosh, I only got 3 showings on this first weekend. Then I go through and do the research, and that's what they should have expected.
Yes.
And so again, if you need help pulling those numbers, reach out to me and I can help you. Right now, I'm pushing about a 24 to a 48-hour turnaround time to get those numbers out. So give me a little bit of time to get those numbers to you. But last week was 3.6 shows per property per week. So if you're not getting 3.6 shows per property per week, it may be time to consider a price reduction. You're not getting the foot traffic you need. Conversely, we looked at about 13 showings to go under contract. So that means if you've had a total of 13 showings and no offers, that you need to go in and reduce your price. And so in order to pull these additional showing reports, you need to have the updated showing time account. And the report that I use is called Target Market Analysis. Enter in a zip code and a price range, and you can pull out all of the showings for the last month or just the last week to see how many shows per property per week there are.
Now, is that like a premier subscription?
It is a premier subscription.
Okay.
It is a premier subscription. Looking at where we were for median days on market last week, it dropped from 7 to 6. So the market actually sped up this last weekend. And so about 6 median days on market at this point. Price reductions ended up declining by about 4.2%. So now we're looking at about 20.6% of all the homes that went under contract last week made price reductions, with 77.3% remaining unchanged. The size of the price reduction went up, however, it was a 4.7% price reduction, or about $37,000 off of the original asking price. Now, again, I have this broken out for you into $500,000 price segments so that you guys get this information for your specific areas. So make sure that you go through the entire report when I send it out a little bit later today, so that you guys can review what's happening in your zip code and your price range. We had a couple of questions pop up, and then I'm going to turn it over to Nicole for you. Do you think the activity for attached units will dwindle or increase due to affordability? The numbers for attached units going into April were actually down more in the attached market than they were for the detached market. And if you think about where the bulk of our attached units are located is in that central Denver market. And so again, looking in that central Denver market is where we're seeing the bulk of those transactions happening right now.
I was trying to get it off of the dual, but
I always do something to it that screws it up, don't I?
Sorry.
I can't quite tell from the zip code index, but how about 80203? So in there, I will send out the report in the back of the attached and the detached reports for download. There is a zip code index where you can scroll to the back of the report, and there's a zip code matrix that shows each individual zip code, and they're all color coded just according to the map how they are. What was the resource again for showing time? So showing time, you have to have the updated account. I use in the reports, the target market analysis. Is it not competitive? It looks blue. So if you are in a blue zone, yes, it is less competitive overall than the rest of Metro Denver. If not priced correctly, what are the stats in regards to price reductions? We just went over those numbers. I'll send them out to you again. It was about 20% of what went under contract last week made a price reduction, and the average price reduction reduction was 4.7% off of the original price. Historically, don't attached units come down first in a declining market? Not necessarily. It's really dependent on what's happening with new construction in a given area versus what's been happening with the detached market. And so it's not historically true that attached units fail before detached units fail. So let's see, does it not include Broker Bay? So Broker Bay, let's talk about that real quick. I've provided feedback to the MLS about what's happening with Broker Bay. I cannot extract data from Broker Bay like I can through through showing time. And so there's going to be a variance of about 10% from the numbers that I look at versus if I were to go through and add in the showing time numbers. And so, looking at what's been happening with Broker Bay, only 10% of the overall listings are currently accounted for with a Broker Bay showing versus a showing time account. I'm working on it. It has not been easy, but I am working on it.
Yes. All right. So we're going to go into the second half. We're going to talk a little bit about what interest rates are doing. Of course, we just had CPI. May 10th finally arrived. Right? I mean, we've been talking about May 10th since February, and I'm a little over it, and I'm glad it's gone.
Yes. Well,
and it didn't do what it was expected.
It didn't do what
do.
everyone had thought it was going to do. And I, for the record, what did I say? What did I say? I said it's not going to happen. I said it's not happening. Inflation is not under control.
Does anybody argue with you anymore?
Well, yes, but I have charts and graphs and data prepared to prove you wrong. I am researched. Nuts about this stuff.
I love that about you. All right. No, it's so true. So May 10th came and it went, and I'm going to share with you exactly what happened with the CPI. This morning we got the PPI, show you what's happening within the interest rates and that we're still trading within the range and how that's impacting our buyers and sellers. You guys having this conversation, especially because so much of the conversation was hovered around May 10th. Yet I will tell you that inflation's coming down. And that's a really, really good thing. The core is hanging on. Like, it really doesn't want to go down yet, but the headline, everything around it. Eggs came down.
Oh, all right.
Yeah, no, that's kind of a big deal.
I filled up for like $4.25 for premium gas.
Yes.
For the other day. I was like, that's not as bad as it was.
It was bad. It was part of the reason why the April numbers were as high as they were. So I'm going to share my screen and let's just jump into this. I know how to share my screen, and yet it's always fun for me. All right, here we go. So, we talked about the lemonades, we talked about finding winners. Let's just jump into May 10th. May 10th is here and what that means. And so we were expecting May 10th to be kind of a big deal, primarily because of the comparison. Now, a couple things happened this last month. Oil was higher than what was expected. We had some used cars were really, really high. And then, of course, you just have life. Like, you can't predict something 3 months early and expect it to be spot on. And then, of course, there was a change. The BEA, which is the Bureau of Economic Analysis, did some shifting from 2022 inflation numbers that shifted it slightly. I'm not really going to throw the BEA under the bus because it really didn't make that much of a difference. But May 10th was supposed to be a big deal, but ultimately it wasn't. We did drop, though. Our headline dropped from 5% to 4.9%. That's a massive move in the overall trend lines. It's the 10th straight month that the headline CPI numbers dropped. Yet, what you can kind of see in the gray here is the core. It's kind of been hovering. It's been staying. It was 5.5 last month, 5.5. It's staying pretty tight, yet the headline did drop. Now, the headline and core both were up 0.4% month over month. We're starting to get some traction in that slower, but it was pushed up by used car sales and gas prices. Shelter, which has been a big conversation, right? We've shown the slides several times where we would see the shelter numbers kept going up at a rapid pace. Meanwhile, we saw it. The rents were coming down, home prices were coming down, all of the appreciation numbers were coming down, but the inflationary cost for shelter and the owner's equivalent of rent were both going up. That now has officially crested. So that's going to start coming down. So this is why some of it is just baked in the fact that it's a comparable number. And some of it is baked in the fact that it's a real cost of things. And I'm going to show you the PPI numbers here in just a second. The real cost of things is coming down. So what you have is a comparable number that needs to catch up with the real cost of things. So the comparable number has tipped over. It's starting to come down. Shelter is a third of the CPI number. So as it tips and it starts coming down, you're going to start to see inflation continue to do that drop. And that's really, really good news. When the headline number, the CPI number, just dropped below 5%, it officially dropped below the Fed rate. So the Fed rate now, with the last raise that they just did, it's 5 to 5.25. It's always a quarter range. So the Fed rate is 5 to 5.25. The CPI number just dropped to 4.9. As long as that doesn't go back up again, the Fed doesn't really need, and it gives them reason to hold. They don't need to raise it again. They could just sit and hold.
So are we going to have some consistency and a lack of volatility in our market for a little bit?
We can hope so.
Oh, that would be a beautiful thing.
We can hope so. And we are going to see, as that inflation starts to trend down, it doesn't happen overnight. It's going to take probably the next 3 to 4 months, but you would expect that with each report, inflation will get a little bit weaker. We will see a little less inflation numbers and a little less pressure on our interest rates, and it will start to come down below 6%. It's going to give us a second half of the year where we're going to continue to see transactions. We're just not going to see them at any level that we want to see them, right? Because you keep talking about the fact that, and I believe it too, I mean, our overall volume count is down. This is the year. It's an entire year where we have to continue to sharpen our saw and be specific in our communication and the way that we're staying relevant to our database, because this is the time. I talked about picking the winners, that there's a buyer and a seller for every market. There's also a winner in real estate. There's winners in title. There's winners in lending. Those of us who are staying on top of the data, that are staying relevant, that are staying in communication, that are educating, are going to gain market share.
Yes.
All right. It's just inevitable. And as you do that, like, think about the fact of all of what's happening with the taxes. It's a news cycle that you can't prevent. I mean, you could sit there, and I've seen it on social. You've seen the people literally getting upset, getting mad, using, I don't want to say vulgar language because that's not true, but just negative energy, right? So you've seen all the negative energy on social media about all the changes that's been happening. And ultimately, what does that gain you? I mean, it happened. You can't take away the fact that we went up 44%. Yes, we dropped 7%, but that gain in value, the tax rate. In fact, I did see that Polis did drop across the counties. Our tax rate actually dropped down from 7.15 to 6. I'm going to mess this up. I think it was 6.86. I was just looking at yesterday. Okay. Do you know off the top of your head? I think it was like 6.76 or 6.86. I just have to look it up really quickly, but it did drop. And we did a survey yesterday afternoon, and it's across all counties. So they did put that into place as a temporary. There is a bill that's coming out in November. So you're going to want to vote on that. They're talking about dropping the tax rate, but right now it's just based on the appraised values. So how are you communicating that change? Are you educating, and are you the resource and the ambassador for the industry? Because we will end this year with the winners having more market share. It's just, it's inevitable. So, all right. So the federal funds rate is now higher than the inflation rate. As long as the inflation rate continues to go down, I would expect that our mortgage interest rates will continue to go down, could foster a little more activity in a slow market this summer. If we see some sellers taking advantage of the lower interest rate, we already know we have buyers who are wanting to come in. Now it's just a matter of getting enough inventory so that they have something to buy. The FedWatch tool continues to change. It's a living document, but you could check it out anytime you want. Right now, they're saying in July, there's a 50-50 split on whether or not the Fed will start dropping, not increasing, but will they hold or will they drop? Now, this is not the Fed saying this. Powell didn't say this. This is the market. So that's why I was so worried walking into the 10th,
Mhm.
because if inflation had popped up, it was flat pretty much.
Mhm.
But if inflation had popped up, the entire market was baking in this drop in the Fed rate. They moved it up from September to July. So it would absolutely crush the market.
Mhm.
And we would have seen interest rates spike up. Now we saw them dip a little bit and then they were just kind of held there. So it didn't really move the markets. I'm going to show you that here in a minute, but it didn't make them worse. And that's what we were kind of worried about if inflation did come up. Now, a big portion of the market is expecting that the Fed is going to start dropping the rates in September. Again, this is not Powell. This is the market estimation. But if this happens and we see through the summer inflation continuing to drop, that could give us the fuel for lower interest rates and a little more activity going into the fall.
Mhm. Mhm.
I'm going to hope that you're wrong just for a minute.
I know. I need it. I need it. I need it.
I'm just going to.
I can't peek yet. I can't. It's too early.
I know it is too early.
It's too early.
It is too early to peak.
March cannot be my best month. It can't.
Oh, you guys gotta get busy. Keep Megan and I busy. That's just all there is to it.
Bad things happen. I get destructive when I'm not busy.
What does destructive Megan look like?
Destructive Megan, like I purge my house and get rid of stuff.
I can see that.
And it like,
I
I
see
like
that.
over
Clean the
get rid
house.
of stuff where I'm like, oh, well, maybe I did need forks.
More plastic forks or more silverware? Yeah. Oh, I need furniture in the patio, right? All right. I was just checking to see, make sure we were good on Facebook, but all right. So the PPI, oh, fabulous. The PPI slowdown for the 11th straight month. It's actually 2% right now. This is the thing that tells me that the CPI is going to continue to drop, because remember, the PPI is kind of your heads up. It's that wholesale inflation, the producer's price index. So this is the thing that before it gets to the retail centers, the cost that it cost producers to actually bring that product to the consumer. So this continues to drop down for the 11th straight month. So very excited about that. All right. We can, oh, I can't spell unemployment. So we continue to just ignore the typos.
And employment.
It was early this morning. We're both becoming.
Did I tell you
earlier and
about
earlier
my
voices.
epic fail for a typo in a report?
What'd you do?
I published a report to 10,0id people about the shift in the
Oh,
market.
no, you didn't.
And I left the F out of shift. So the market took a big shit.
Did I get that report? When did you
that was probably about 8 years ago that I
Okay.
sent out that report, and I got instantly like my
Yeah.
40 phone calls.
That's
They're like, do
awesome.
you realize what you just sent out? And I was like, oh my gosh, whoops.
Although your
Whoops.
your reader count probably went up.
Yeah.
Yeah.
People pay attention to the stuff I put out now because I curse inside of
Yes.
my reports.
I love that.
Yeah.
So the unemployment is so seeing a 3.4 number, you have to go back to March of 1969. That report came out last week, since we didn't have a market trends last week. Of course, it came out on Friday. We wouldn't have talked about it anyway. But in all of these things, we're just watching what's happening with jobs. So we're seeing the cost of shelter is just tipped over. We're seeing the PPI numbers have dropped. All of this would go into the CPI. The CPI would then lend into a lower interest rate. Lower mortgage interest rates are going to continue to give you more buyers and opportunities for conversations with sellers. All of this is good to know. Do you have to know the exact number? No, but do you want to know the trends and where the market's headed? Everyone is talking now about a recession that's going to happen, but is it going to be mild? And ultimately, are your buyers and your sellers going to be impacted? It is a very specific recession that's impacting very specific industries.
Mm-hmm.
It's definitely impacting the banking industry. It's definitely impacting the technology industry, but there's a lot of buyers and sellers it's not impacting. So let's continue to go through this. We have less job openings slightly. So we dropped down from just under 10 million to 9.6 million, but we still are left with 1.64 jobs per unemployed person. This is going to continue to support our wages and our employment right now. And as long as our employment is continued to stabilize, we're not going to go into a deep recession. It's going to be a mild recession. Initial jobless claims did pop up, and we're also seeing, excuse me, and we're also seeing recruiting dropping off. In fact, ZipRecruiter just came out with their quarterly earnings. Those dropped off substantially as we're seeing recruiting activities. We're seeing a lot of corporations are doing a wait and see through the end of the year, which I'm kind of feeling that too, right? Wage growth is cooling slightly, but it's more stabilizing. In fact, there's a lot of conversation right now. If you take all the data, we're really going back to a pre-pandemic type of market where wages are stabilizing and we're not going into any kind of wage spiral. So that conversation's off the table, which is really good news. The consumers continue to spend less. Consumer spending is flat. Retail sales are down 1%. This is continuing to fuel into our GDP, which actually now has 2 consecutive quarters of GDP decline. So it could be a recession.
It's a recession. Declare it already.
We could actually be in it. Now they have they've actually changed and added more measurements to what defines a recession. It's just not as easy as 2 consecutive quarters. But this is something that people are pointing out, to the fact that we are heading into the slowdown. The consumers have become more picky. They're not spending as much. All of this is going to bring that economic slowdown, which we need, which is just a supply and demand equation, whereas more supply, and we're actually starting to see more sales. Have you noticed that?
More
I started sales at like the consumer stores, at like the Target and the Walmart and the electronic stores, especially.
I'm on a budget. I
PCs
haven't
on
been
sale.
shopping because I peaked in March.
I understand that.
I'm on a budget.
I'm on a budget. I'm on a budget, but
I
Amazon
stopped
still
spending-
comes every other day.
I know. Well,
Yeah.
when I want to shop, I shop for my kids. So I'm like, I have to buy this.
Yes, I would agree with that. Well, we are going to see a lot of sales this summer because we're already talking about the fact that we're seeing more inventory swell. So as this demand is getting more picky and is settling down, that inventory, which you can't a lot of it you can't stop after you've already placed the orders and it took an extended period of time to get there. Those inventories are going to stock up at the stores. So be on the watch for some sales, especially as goods is softening, yet services are still staying strong. All of that good to know for your spending. All right, so the Treasury is staying within its narrow range. The CPI didn't break it. The PPI didn't break it. The Fed meeting last week didn't break it. Nothing is breaking it. We're staying inside that range until we see a significant drop in CPI, which we were really hoping for on May 10th, but that didn't happen. So as June and July come up, we'll continue to watch this. But we are at the bottom end of that. So this is where we landed in the last couple of days. But it didn't really move the markets that much. We dropped off about an eighth, less than an eighth in interest rate. So we're still hovering in that 6.5-ish range. Now, remember, a lot of it has to do with your credit score and what you're buying and how much down. But the FHFA did take off the debt to income ratio from the table.
Oh,
That was going to be another hit to the interest rates if you had a higher than, I think it was like even 40% debt to, it was really low. But that's on the table. So they were discussing it, they put a hold on it, and then they just took it off the table entirely. So the LLPA changes that went into place May 1st are the ones that are staying. There's not an additional one coming out this year as of right now. Mortgage purchase applications went up 5%. So I'm busier. We got to get you busy.
I got to get busy.
I'm not actually busier. I'm busier on the front end. We're just not closing them yet.
I need
right?
to go under contract. I need
is.
people to pull the trigger. Is what I need.
Yeah, they got to find that perfect home.
I know, they're so picky.
But
They're
they want
so
to
picky
do
right
it.
Yeah.
They want to do it. So we just got, guys, we
now. Is
just
the
have to
market
stay in.
constipated? They want to.
They can't. Okay, that's gonna be a quote that's gonna go out in the email following this. Cara and Ashley, if you didn't hear that. Okay. Yes, the market is constipated. So let's talk about some good news, maybe flush it out. The movement boost. So we put this up on social. A lot of people are like, tell me more. And I want to tell you more because this is a movement mortgage only product. It just got released. So I'm super excited about rolling it out. Now it's a little bit different. So Chaffa and MMA, fabulous products. We do a lot of them, but Chaffa and MMA both they both stop at a 4%, right? So both of them have a limit of a 4% down payment assistance, and they both have lower income limits. So the Movement Boost program will let you go up to 5%. That makes a big difference. So if you think about the fact that an FHA loan is a 3.5% down, and all of the down payment assistance programs have a 1% origination fee with a 4% down payment assistance cap, you really only get 3%, which doesn't even cover the down payment. Now with Movement Boost, you have 5%. So you're going to cover the whole down payment and some of the closing costs. You can go down to a 620 credit score and up to 160%, which is the highest I've heard of, up to 160% of the area median income.
Okay.
In Denver, that's 188,000.
Wow.
So that's really huge.
Okay.
So we'll be able to go, you can make up to 188. I would question why you don't have 3.5% saved if you make 188,000, but there's a lot of circumstances that I can't even get into. So can we get you over the hump? Now, the one downside to this, and I will tell you, everything's got pros and everything's got cons. The one downside to this one is it's not a silent second. You will start making payments on it right away. Yep. So, but it is a fantastic alternative. If you can't save fast enough, it gets you in and then you can refinance. There's no prepayment penalty. You can pay off that second as soon as possible and get out from under it and then have that home that you just couldn't quite get into, especially right now. If we know that if we're seeing mortgage purchase applications up and we're going to continue to see demand on those homes that are priced well and staged well, you want to get in now, because when the interest rates drop, if we see a little bit more demand come out, those home prices are going to continue to go up. It's only going to cost you more. And it is in all states except for New York. You don't have to be a first-time home buyer, which is really awesome. And then Movement Mortgage, one of the big pluses with coming over here is we do all of our in-house servicing. It was one of the biggest complaints that you sell your loans. We don't sell our loans anymore. So it's a one-stop shop. We can converse with everything from origination through servicing, whether you're trying to recast, refinance, whatever you're trying to do, it's always going to be through the same service center. And I love that. That has always been our biggest complaint. Servicing companies suck. Building Investment Empire tonight. Don't use this QR code. I don't have the right one up here. We're going to be sending it out in our email. So Building Investment Empire tonight got moved to Zoom. That's why I want to tell you that. With our flooding and the rain, we're just like, you know what? We just don't want to be cozy with a sweatshirt on. We're going to do it at home. Please join us. Building Investment Empire is going to be online on Zoom. We'll have that on our email that we send out here in a little bit. Okay.
No, it's still
okay. Is it still going?
It's still going.
All right. Well, if you guys can hear us, our monitor stopped. But if you guys can hear us, make sure to join us on the Wednesday.
It's not
still
taking
going
care of now.
What was the last thing?
I don't know. Oh, yeah,
Okay.
it's still going.
It's still going.
It's
Our
still going.
monitors just cut out, but you guys can still see us. Well, there you go. Crazy power. So you guys make sure Wednesday you want to talk a little bit about the property tax?
Yeah,
class
so
that
we've
put
got
together?
3 different agents who've been doing a lot of property tax assessment and contestation.
Yes.
Contestations?
Yes.
Yeah, and so they've been contesting their taxes. And so they've been helping a lot of consumers out. And so I wanted to bring in someone, a group of agents who have been doing this on a widespread basis so that we can get more agents on board with this and helping people out in when they want to contest their taxes. And so it's going to be on Wednesday from 1 to 2:15 because you've got a flight to catch and I booked you right up until the last minute before you can leave for your flight. But we are out of room in person. We've got it sold out for 80 people and we've got 1,020 people already registered after one email online.
Yes.
So I will send out that registration again. I might have to fiddle with my Zoom settings because I have a maximum of 1,000 people for my webinars.
Yeah.
And so I might have to up that for this one to make sure that we can
Oh,
get it right.
wow. Yeah, okay. You think you can up it?
I think I can up it.
Okay. Well, and if you really want to squeeze in person, you know that last minute, a few people will have listing appointments or showing appointments or hair appointments or whatever. So go ahead and come by if you want to try and squeeze in person, but absolutely, we'd look forward to seeing you guys there. There's a lot of conversation to be had. Make sure that you're sharpening your saw and staying in front of it, because really, guys, this is the opportunity to build your database. So that's all we've got for today.
Yeah, and I have no idea how to end this because
No.
our monitors are out.
Miss Ashley can sign in this you and end it for us.
Okay,
Yeah.
Miss Ashley will sign in and end it for us. That would be fantastic. This was a lot of fun today.
It was a lot of fun. A lot of fun. And I love this ending because this is. We'll figure it out. But you guys have a great rest of your week. It's supposed to be rainy all week, but this weekend is supposed to be beautiful. Sun's coming out on Friday. If there's anything that we can do to support you as you continue to support your clients, please, Megan and I would love to see you at your closing tables. You guys enjoy, and we'll talk to you very soon.
Thanks, guys. We'll see you later. Should we
Bye-bye.
fade out like awkwardly?
Let's awkwardly.